All right, accounting students, we're going to look at a couple examples. Well, I'm going to look at an example here, probably another video for a second example of some problems on homework. Now, I would like to be able to put out a video every week on either lecture material or some sample problems, but I won't guarantee that right now. It's what I plan to do, but we all know plans can change. So right now, this is a sample from your text. This is 1-1 on the back of the book, problem 1-1. And this is very similar to what you're going to see on your homework. So we'll talk about this a little bit. What we've got here, essentially, we've got items from the balance sheet here. We've got income statement items here, and then over on the right, we've got statement of cash flows. Now, the statement of cash flows, if we don't do anything with cash, we're not going to worry about cash flows. Okay, so if it details cash in a transaction, then we're going to look at it over here. Yes, but um, we don't. Whoa, we don't have to do that. All right, so let's take a look here at what we've got. We'll run through these, and hopefully you'll be okay with everything. So receiving $700 cash for services provided. Okay, so we didn't even think about this. What did we get as a company? We're looking at this from a company perspective. From the company received cash. Okay, so cash is an asset, so we'll see $700 here. Now, if you remember, this is revenue. So essentially, this is a part of our equity also. So we also increase equity by 700. And again, because this is revenue, revenue goes on the income statement. So it is a plus 700 net income. And then from cash flow perspective, since we did receive cash, we need to put this in our cash flows. And this is what we did for services provided. So if we do this in the basic operations of the goods we make or the services we provide, it goes into operating activities. It goes into investing activities if we're looking at spending cash on like equipment, a long-term type of asset, equipment, a vehicle, anything like that goes into investing. You have to think about we're investing back into the company. Financing activities are activities where we look at essentially we're either loaning money or borrowing money, or we're looking at something like paying dividends would be a financing activity, as well as we look at the first one there, which they've already got filled in for us. Where exchange for stock. Stock is a financing activity too. So when we're talking about the company selling its own stock or paying dividends, these are financing activities, as well as if we're borrowing money or loaning money out. So the services provided would be part of operating activities. So that's going to increase by 700. The second one, you're paying $500 cash for employees' wages. Well, we paid cash. Cash decreases. Cash is an asset, so we're going to decrease cash by 500. Okay. We also need to remember that this is part of equity as well, so minus 500 here for equity. Net income, if we spend cash, cash goes out. This is a wage expense. It's going on the net income. And then as well, since these are wages that we pay, and this is part of what we do to make our money in operating activities, we will have minus 500. Now we're buying $100 of equipment on credit. There is no cash here, so we don't have to worry about statement of cash flows. So what happened? Well, as the business, we received an asset, an equipment. So our assets increased by 100. And we did this on credit, which means our liabilities increase because we're going to be paying for this in the future. We're not paying for it now. So liabilities, increased by 100. The next one, purchase $200 of supplies on credit, no cash here, so we don't worry about cash flows. So we're buying this on credit. What do we get? Well, we got supplies. We got an asset for $200. And then we also increase liabilities. Again, this is on credit, so $200 there. Buying equipment for $300 cash. Well, what happened? Well, we bought equipment. Equipment is an asset, something that we own. So we increased assets by 300. We paid cash for it, so we also decreased assets by 300. And then since we bought this for cash, we have to look at doing something in statement of cash flows for this. Now, this is equipment that we bought. We paid cash, so it is an investing activity. And since we paid cash and cash went out, it's a negative 300. And the next one here, paying $200 on accounts payable. Well, accounts payable is a liability for us, but we also paid something. So if we're paying something, that means we paid cash went out. Cash decreases when we pay it. Cash is an asset. So on accounts payable, we will have minus 200 for the cash going out. And then we'll also have in liabilities, they decrease, so we'll have minus 200 here as well. Number 8, or the eighth one here, providing $400 services on credit. Oh, wait, look at this. Even though we didn't receive cash here, we still have the legal right to collect because we did provide a service or good to someone and we have the right to collect on those. So basically this means we have an account receivable. Our accounts increase by $400, or accounts receivable will increase by $400, and that is an asset. So we will have 400 here. Okay. Now, this is a revenue. We provided something for revenue, so our equity is going to increase as well by 400. We will also see on net income, this will increase because this is a revenue. But we didn't receive cash, so we don't do anything in cash flows. Now, paying $50 cash in dividends, well, we should know whenever we pay cash, we're decreasing our cash, which is an asset. So we have minus 50 here. Also, when cash goes out, it's always in part of equity, so we have minus 50 here. And as well, we're paying in dividends, and we need to catch this. This is part of financing. So we get a minus 50 because cash went out for financing purposes. Cash decreased. And the last one here, collecting $400 cash on an account receivable. Well, if we're looking at this, essentially, we received cash, which is an asset. So assets would increase by 400. But also accounts receivable decreased, and that is an asset as well. So we're going to have minus 400 here. Right. Now, the other part that this affects is we look at this, and you might think this is going to affect accounts, or I'm sorry, accounts receivable will affect that. You might think this will affect net income, but it's not going to affect net income at this point. Because basically, if we think about it, we already have it in net income here. So when we collect this $400 cash on accounts receivable, basically what we're seeing is we got $400 cash. We increase an asset, which will be our cash, decrease an asset, which is accounts receivable, but we also got cash, so it has to go on a cash flow. And this is because of what we do. Accounts receivable would be when we sold somebody something or provided something. So we will have plus 400 to operating activities. So this is what we look at. This is for problem 1. This is real similar to what you may see. I'll have another video on problem 2 here soon. So see you later. Bye.